Welcome to the Christian Super Centrelink Income and Asset Strategies webinar. I'm Gavin Martin from Cornerstone Wealth, and we have Phil Watson, the Digital Marketing Coordinator for Christian Super, here as well. So, Phil, unless you have a few other comments, shall we open in prayer and get underway?
Yeah, let's do it. Let's start this thing off. Father God, we thank you for Monday nights and being able to hear the wisdom of Gavin, and we just ask for your help for Gav tonight as he shares. We just ask for your blessing on his family who are at home, probably in bed right now. We just thank you for the greater Christian family that we are across Australia. Lord, we ask for technology to work. We ask for just for your insights into maximising our retirement. Lord, we ask for just for wisdom for all of us as we make financial decisions. And Lord, we just ask for your help to, just to use the finances that you've given us to have purposeful retirements and just have the kind of life that you want us to lead. And we just thank you for Jesus, who makes everything possible. In his name I pray. Amen.
Amen. Thanks, Phil. Really appreciate you coming.
No worries.
Just a disclaimer that just take tonight's information as general information only, and seek personal advice relating to your own personal circumstances before making any decision. If you do want personal advice, we can assist you with that. The way we go about that is have you complete a questionnaire. We then meet with you for what we call a discovery meeting. That's trying to understand your goals, what you're trying to achieve, looking at what your current circumstances are, and then discussing the pros and cons of the range of options available to you. That might be sufficient for you, or you might go to the next phase where we prepare and write up specific recommendations to you in what we call a statement of advice. We can also then help you implement it and provide ongoing advice as well. So that's the full process that we go through, and you can take it as far along that process as you like. So the first thing that we're going to cover off is the age pension strategy, where there's a younger spouse and only one spouse is eligible for the pension based on age. And your eligibility age are basically these ages. So if you look at what your date of birth is and what your age is, you'll work out what your age pension age is. That's at the age at which you're eligible for the pension. And if one of you is eligible and one isn't, then you'll get the one that's eligible has the potential for getting a full age pension, which is $674.20 per fortnight, or $17,529 per year. A single's full pension is $23,254 per annum. So, if you want to know a bit more about the age pension, go back to the other webinar that we did last month that's available at cornerstonewealth.com.au/Centrelink 2017, and it walks through a lot of detail. I'm just doing a small introduction so that we have the context of this particular strategy. So with the pension, you can there's the maximum potential, single maximum of $23,000, a combined couples pension of $35,000 is the maximum. And then depending on the income test or the assets test, whichever test provides the lowest amount, the lowest rate, that's the test that will apply, and then you'll get no pension, a part pension, or a full pension. So the key question is, what happens when only one member of a couple is of age pension age? Well, what happens is the same income and asset test applies, and the tricky part is where there's an age difference and one spouse is eligible for the pension, one isn't, but the younger spouse continues to work, earning over the combined income threshold of $77,917. So if one person is eligible and the other person is still earning, or even if the person who's eligible is still earning income over the $77,917 per annum figure, the older person will get no pension. There's not a lot you can do there. You're always going to be better off earning the $79,000 or more in income rather than receiving a potential $17,500. So it's always better for the younger spouse to be working, but there is a circumstance where both spouses may not be working, or they might be working at a low rate, where you can start to structure your assets to maximise the pension benefits. Income and assets are combined, whether you're eligible for the age pension or not, and if your income is below $300 per fortnight or $7,800 per annum, then you'll get the full age pension. So that's your combined income is below those thresholds, then you'll get the full age pension. The eligible person's rate of pension reduces by 25 cents for every dollar over those amounts, over the $300 per fortnight. And then there's no pension payable if your fortnightly income is over $2,996 per fortnight. So that's the criteria. So what can you do if that is your particular scenario? Well, you can try to reduce your income, and this is what income includes. It's your employment income, any salary sacrificed income, so salary sacrificed to super or vehicles or other things you might salary sacrifice your income to. But it doesn't include the work bonus. So for the person who is on the age pension, they can earn up to $6,500 per year of employment income, and that's not assessed for income purposes. The younger spouse who isn't eligible for the pension does not have that work bonus, so the first dollar that they earn impacts the age pension. Overseas income's included, income streams and superannuation pension is included, rent from real estate, farm or business income, and deemed income on financial assets are all included in income. So if you can reduce that income or that assessable income, you could potentially increase your age pension. As I mentioned, here's the threshold for employment income. So the person who is of age pension age can earn up to $6,500 of employment income, but in addition to the threshold of $300 per fortnight. So it's another threshold that's available to the person who is eligible for the age pension. Assets include motor vehicles, boats, caravans, household and contents, personal effects, bank accounts, investments, real estate, farms, businesses, antiques, collectibles, and gifting over the thresholds. And the thresholds are $10,000 per financial year, or $30,000 over 5 years. So they're called assets. So if you can reduce your assets, then you could potentially increase your eligibility for the age pension or increase your age pension. Now the key thing here is that things that aren't considered assets are your family home. So one quick way to decrease your assets if you are asset tested is to put some money into your home. So spend some money renovating your home, because that's not an assessed asset. You don't want to do that willy-nilly, not as in not getting any value from it, or it's not required, but it is a way, if it lines up with what you're trying to achieve, then it is a way of reducing your assets. Accommodation bond for aged care isn't part of your assets test, nor are funeral bonds or prepaid funerals, disability trusts. And the key one that we're going to focus on is superannuation funds that are up until age pension age are not assessable. And so the strategy we're looking at is about holding the assets in the younger spouse's name in this accumulation phase of super to minimise your assets and therefore maximise your pension. So let's look at an example. Always easy to use an example. We've got Sam and Sally, and they're 65 and a half, so Sam's eligible for the age pension, and Sally is 57 years of age. They're married. They own a home worth $800,000. They've got $30,000 cash in the bank, and they've got $600,000 in Christian pensions. They've also got $100,000 in shares, and for the Centrelink purposes, their home is excluded from the assets test, so it doesn't come into play at all. So this means that they've got their total assets that are tested for Centrelink are the $600,000 in pensions, $30,000 in the bank, and shares of $100,000. What I haven't included in here, which probably should include for completeness, is other assets that would be tested would be cars and caravans and those sorts of things, but we haven't included them. We're assuming that they haven't got them, don't own them. So the total assets here are $730,000. The lower asset threshold for the Centrelink is $380,500. So the assets over and above that amount are $349,500. And for each $1,000 over that threshold, for each of those $349,000, the pension is reduced by $3 per fortnight. So it's reduced by $1,048.50 because of the $350,000 over that threshold. The maximum pension they would have been eligible for is $1,348 per fortnight as a couple. And so the difference between those two, because of the assets, is just under $300. That's what they would be eligible for as a couple. But only Sam is eligible, so he'll only get half of that amount, which is $149.95. About $150 per fortnight is what Sam and Sally would be eligible for in terms of pension. Now, this is where we can start to think about, well, what's another way of structuring things? We're assuming that they're both not working. So what we can do is we can move superannuation money into Sally's accumulation account, and that will then reduce the assets test. So we've got $440,000 sitting in Sam's Christian pension account. We've got $160,000 sitting in Sally's Christian pension account, $100,000 in shares and $30,000 in the bank. The first thing we can do is cash out $200,000 of Sam's Christian pension account and put that in the bank. Now, because Sam is over 60 years of age, there's no tax payable on that $200,000 withdrawal. So we've moved $200,000 of Sam's super into their bank account. The other thing we can do is we can roll over $160,000 of Sally's Christian pension. We can roll it back to the accumulation phase. So that's not taking it out of the superannuation environment. It's just rolling it back to a different type of account, an accumulation account rather than a pension account. The other thing we could do is sell all of the shares that are held in joint names. So one thing we need to be careful of there is that you could incur some capital gains tax, and you just need to make sure that you don't incur too much tax in that sell down. But let's say that we're either able to manage the gains or there are no gains on the shares. So we've sold the shares and we've put the money in the bank. So now we've got $330,000 in their joint bank account, $240,000 in Sam's Christian pension, and $160,000 in Sally's Christian super. What we can do now is there's a contribution limit for somebody who's under 65. Sally's under 65. We can put in $100,000 a year, or if you're under 65, you can bring forward 2 further financial years to put $300,000 into her super account. And so that's what we're proposing doing, putting $300,000 into Sally's super. And now we've got effectively $460,000 in Sally's Christian super accumulation account, not tested for Centrelink purposes because she's underage pension age. So the only assets now that are tested for Centrelink's purposes are $240,000 in Sam's Christian pension and $30,000 in their bank account. And the beauty about this is that we're trying to keep as much as possible, as much of their assets as possible in the pension phase of superannuation, because it's tax-free earnings on the $240,000 in Sam's Christian pension. So what this looks like now is that if we look at the circumstances in this case, the house isn't tested, and the $460,000 that is sitting in Sally's accumulation account is also not tested for Centrelink purposes. So it's a very different assessment this time. All we've got is $240,000 in Sam's pension and $30,000 in cash that are assessable assets for Centrelink purposes. The lower threshold is $380,500, and that means that they're not impacted by the asset test at all, and they'll get the maximum pension. A couple's maximum pension is $1,348, and therefore Sam would be eligible for a fortnightly pension of $674.20. Now, we've conveniently also set their assets at a level that the income test won't apply as well. You can have an income test of, you can have financial assets of up to 278,492 and not affect your pension. If you've got financial assets over and above that amount, then it can reduce your pension, even if the asset test doesn't, because of deeming rules. But that's a pretty good outcome. So that's the crux of this strategy, that we're holding assets in the younger spouse's accumulation account. And in this case, with Sam and Sally, we're increasing their fortnightly pension by $524.25 per fortnight, which is $13,630 per annum. If that's going to apply for 10 years, like in Sam and Sally's circumstances, because Sally's going to be eligible for the age pension at age 67 in 10 years' time, that's $136,300 in age pension benefits that they are eligible for that they otherwise would not have been eligible for. So it's a great outcome and something worth considering if this is your circumstance. One of the concerns that people often have when applying this strategy is, well, how are we going to come up with the income that we need? So let's have a look at that. We've got, as we said before, $240 in Sam's pension account. We're generally drawing 5% from that account. So we're drawing $12,000 from Sam's Christian pension account. We generally set that at the minimum amount, which is 5% for somebody over 65. They're also getting Sam's also getting the full age pension, so $17,529. So their total income is $29,529. You might also be some small amount of income on the $30,000 in the bank account, but really and that could be, the cash reserve could be used actually. So your let's assume, for example, that their income requirement is $50,000 a year, so we need another $20,000 to make up the $50,000 in addition to this 29. So we could use the bank account, so the $30,000 in the bank account, we could use that for the year, and so then it would drop down to $10,000 per annum after that year, having used $20,000 from the bank account. It's at that point in time that you probably need to draw on some of Sally's Christian Super account. So you can draw potentially $20,000 out of there to replenish the bank account back up to $30,000. So really that's the way that you're able to continue to provide for your income requirement, by drawing down on the super account over time. Now, one thing you need to be careful of is that if the younger spouse who we've put all the super monies, whose name we've put all the super money into, if they haven't satisfied a condition of release, you wouldn't be able to access lump sums like this freely. You'd have to roll to pension phase. So just be careful of that. We mention it at the end with when we talk about considerations, but just need to also be cognizant that a condition of release needs to be met to do drawdowns on the younger spouse's name. So that's how we can effectively make up the income requirement of just around $50,000 by drawing an extra $20,000 from Sally's super account. Now that might happen year on year, so we might have eaten into the bank account, the $30,000 has gone down to $10,000. I think we draw another $20 from Sally's bank account. And then when Sally reaches pension age, then whatever's left in her Christian super account is then, it's better then that it becomes accessible for Centrelink purposes, because she's 67, she's reached pension age, and now it's accessible for Centrelink purposes. And therefore, you're better off then rolling back to the pension phase and starting to draw pension from it. So then you could start drawing $20,000 from the pension account rather than doing lump sum drawdowns over time. So that's how the strategy works broadly. There are some considerations that you need to think through. One is that, as I mentioned just in prior slides, is that you need to ensure that you've got sufficient access to funds of the younger spouse. Otherwise, you might need to draw down on the older spouse's super a little bit more, but that can work, but you just need to make sure there's sufficient cash flow there. Talking about cash flow, you need to make sure you can make regular drawdowns from super, whether that's from the older spouse's name or the younger spouse's name. There is one impact of being in the accumulation phase that is a negative, and that's tax. So on the $460,000 in Sally's accumulation account, that's taxed at 15, or the earnings on it are taxed at 15%. So if it earned 5% earnings on that, or $23,000, and then that was taxed at 15%, there might be an additional $3,450 in tax paid within the fund. But if you look at the bigger picture, it's still $10,000 a year better off than if this strategy wasn't applied. There's an asset test threshold of $380,500, so it's good to stay under that. But it's also best to stay under what we call that financial asset threshold, because if you have financial assets, so financial assets are shares and super and cash and those sort of liquid financial assets. It's not property. Property is assessed on what income it generates. It's not like a deemed asset, but it's good to keep the assessable financial assets under $278,492 as well. That's the couple threshold. It's a bit over $150,000 for a single person. Otherwise, your pension will be reduced. So whilst the asset test is $380,000, you think, well, if my assets are under that, I'll get the full pension. There is a income test that kicks in before you get to that $380,000 threshold. You need to make sure that there's no capital gains, or you're not going to be really hit significantly by capital gains on the sale of shares. And so the other thing is the contribution limit. So I mentioned earlier, it's $100,000 per annum, or $300,000 over 3 years if you're under 65 years of age. And if you're eligible for the government co-contribution, which is where you put $1,000 in and then get $500 back from the government, sometimes we put in, say, $298,000 in the one financial year, so $1,000 can be put in for each of the next 2 financial years, so that you remain eligible for the government co-contribution. And then finally, the cash-out recontribution strategy. So when we make those sorts of moves within superannuation, like we did with Sam and Sally, we drew $200K out of Sam's account and we put it into Sally's account. That's a cash-out recontribution strategy, and there are other benefits of doing that that can save tax. We talked about that in the estate planning and CGT webinar that's available at www.cornerstonewealth.com.au/retire2017. Now, just check a few questions that have come through. Well, it's a bit of a long one, Judith. I'll have a quick look. My husband has not been drawing a pension, although he has been over pension age for many years. We thought that assets held in my name would count against him. Is that not true? I'm not pension age and I am working. Yeah, it's well worth. So, Judith, the key test is that your superannuation assets in your name are not tested if they're in the accumulation phase. And that's what we're talking about. If you've got other assets in your name, then they will be tested. It's just your superannuation money in the accumulation phase that's not tested. But the key thing is to check whether your income is over $77,000, and if it is under that, then it's well worth considering whether your husband might be eligible for a part pension, or whether you potentially can apply this strategy where you hold more of your assets, potentially some of your husband's superannuation assets in your name, and they become eligible for a larger pension if he is eligible. But it's well worth making contact. They don't back pay the age pension, so I would even call them tomorrow and apply over the phone. So just I'd like to apply for the age pension, and then make an assessment after that as to whether you're eligible. You can speak to financial information services officers at Centrelink. I think you can often ask them over the phone, and they may be able to do a quick assessment of whether you might be eligible. You could mention to them that you heard about the strategy where you can hold some assets in the accumulation phase of super in your name, and they might be able to give you a little bit more info there too. well worthwhile considering though, Judith. So that's the main strategy that we apply quite regularly, getting access to a larger age pension where there's one spouse eligible for the age pension and one spouse not. The other strategy that I have rarely seen implemented, but if you are a bit of a planner type person, it can actually provide some significant benefits. But even if you don't apply the strategy, this will help you understand what happens in relation to Centrelink on the death of a spouse. What does happen when one spouse passes away is that you change from being assessed as a couple to being assessed as a single, and generally it results in a reduction in the age pension, and it can also result in the loss of the healthcare card if you come off the pension altogether. It's probably best to go back to an example. We've got Joe and Mary, so 77 years of age and 68 years of age. Their house is worth $600,000, and we've got a joint account or bank account worth $30,000, and they've got Christian pensions worth $550,000. Again, they're both alive at this stage. Their house is not assessed, and so their total assessed assets are $580,000, and the lower threshold, the asset test threshold, is $380,500. That means they've got just under $200,000 assets over the lower threshold, and therefore their pension, fortnightly pension, is reduced by $598.50. The maximum pension is $1,348 per fortnight, and therefore Joe and Mary will receive $749.90 per fortnight per annum. Now, what happens in the case of Joe passing away? Well, the assets are tested the same way, except then now a test under the singles threshold for a homeowner, rather than having a lower threshold of $380,500. The lower threshold now is $253,000. So this is the singles threshold for a homeowner, and therefore Mary in this scenario would be over the threshold by $326,000, which means that after applying the taper rate, there's no pension payable because the asset taper rate wipes out the pension altogether. So on the death of the spouse, now the surviving spouse loses the pension, loses the healthcare card, and is then fully reliant on their own resources. Now, at this same time, there's fewer expenses because there's only one person, but you've got to run a house, you've got to potentially run a car, and so there's not the massive reduction in the expenses. So you might eat into so in this case, let's go with Mary. Mary might eat into her $580,000 a bit more quickly because she's got to draw $50,000 or $40,000 from it each year, depending on how much she lives on, and it might eat into her asset a little bit more quickly. But she might eat into her asset so far that she'll become eligible for the pension again, and then the rate of that she eats into her assets will reduce as the pension starts to kick in. Now, one strategy that could be applied is that instead of setting up the pension account in Joe's name going to Mary, we could actually have a binding nomination on that to go to other family members, for example. So you might have 2 adult children, and you could actually change the nomination, so the binding death nomination on this account, to go to children instead of the spouse in Mary, and then it wouldn't be assessed as an asset on the event of Joe's death. And so what we've done in this scenario is that $200,000 that was in the pension account has gone to the kids. It's not an asset for Mary, and then Mary is only assessed on $380,000 of assets now, She's only got $380,000 of assets as well, excluding her home. Therefore, she's a lot less over the lower asset test threshold, and therefore her net pension ends up being $515 per fortnight instead. Now, she doesn't have this $200,000 that she can utilise, but she's still getting a significant pension from that, which is probably more than what she would get in the bank. So it's not a bad strategy, but it's sometimes difficult for people to plan around that because they can't think forward enough to think, well, how much do I need to live on and how much is going to be sufficient for me? But it can actually provide significant benefits. If you're thinking of your family situation, your broader family situation as a whole, you're going to be better off keeping$200,000 within your broader family and receiving an extra $515 per fortnight than not. So that's a binding death nomination to the kids. One thing you need to be careful about is that it's best to have tax-free components in that account, so there's no tax payable for the kids on transferring that asset to the kids. That relates to the cash-out recontribution strategy that I talked about earlier. So that's one option. You could send the assets to the kids, or you could, if these accounts were switched around, and instead of Mary having $350,000, you could push it even further and say that Joe had $350,000, and that would need to be the case. They would need to have that amount in their super account. And in this case, if that were the case, if Joe had the larger account, had $350,000, that could be gifted to the kids, and then Mary's assets would be $200,000 plus the $30,000 in cash, and then she would fit under the asset test threshold. So she wouldn't be asset tested because she's under the asset test lower threshold. Her pension isn't reduced for under the assets test. So under the assets test, you would get the full $894.40, but under the income test, her pension would be slightly reduced, but only by $40 odd would it be reduced. So she'd still be receiving $842.74 in age pension. So it's another strategy to consider. I don't see it applied as frequently because it's a little bit more difficult to predict, and you've got to probably monitor it a little bit more closely and think about, as your account balances changes, how might you change the allocation to other family members as well. A few things to consider though is, as I mentioned before, there's tax potentially payable unless you've cleared the tax components in the super account that you've sent or directed to the kids. What else is there? There's significant benefits. So in the first scenario where there was no pension, the surviving spouse came totally off the pension, and in the final scenario where Mary retained $230,000 of assets, she was able to get an extra $22,000 of age pension by implementing that strategy. She might have fewer resources longer term, but it's a significant difference of receiving $22,000 per annum versus eating into your assets. And if you do longer term projections, what ends up happening is that you end up eating into your assets over time to the point that they all have gone, and you haven't had the opportunity then to pass that on to the next generation or to your charities of your pleasing. So there are some benefits of the strategy. There are healthcare card benefits as well, particularly in the likes of New South Wales, where there's no registration fees, for example, for healthcare card benefits. If you come off the pension altogether, you miss out on those. But you do need to make sure you've got sufficient funds to live on. So you don't want to give away or direct all your assets to the next generation on the event of death and then not have enough to live on. And this is what I was mentioning before. Taxable components within super could incur 17% death benefits tax if passed on to a financial non-dependent like adult children. But if you've cleared the tax components prior, that's an ideal scenario where you can potentially direct those benefits to the next generation in the event of death. You do also need to factor in that you might need to pay for an accommodation bond for aged care purposes, and there also may be changes to the income and assets test in the future, so need to factor that in as well, although that's harder to factor in because we don't know what those potential changes might be. A bit of a complex strategy. Here's just an overview of the income and assets thresholds. So if you're a single homeowner, assets under 253,750 would mean that you get a full pension under the assets test. As I mentioned earlier, it's about 157,000 of financial assets that you need to be under to still receive the full age pension. So it's not just this threshold that applies, but there is that deeming on financial assets that you need to think about as well. And then your pension cuts out at 552,000 for a single homeowner, and then you can look at the thresholds for other circumstances. So couple homeowner, $830,000 is the upper threshold at the moment. And if you don't own your own home, you're renting, or you don't own your own home and are living elsewhere, then the thresholds are actually a little bit higher. There are other asset test reduction strategies just to cover off, but you need to weigh the pros and cons of them. So one quick one is that if you're eligible for the age pension, you're on the age pension, just regularly update the value of your cars. They devalue each year. I mentioned in the previous webinar about using Redbook to revalue your cars every year at least to reduce the value of them. You can spend money like on holidays and house improvements, and that reduces your assets. But you don't want to take that too far, because it's really just wasting your money if you don't really want to do those things. You can gift money, $10,000 a year or $30,000 over 5 years. You can put super in your spouse's name, like we talked about at the start of the webinar. Funeral bonds and prepaid funeral expenses, so you can purchase those to reduce your assets. And then the final one is an annuity. If the annuity has a residual capital value of less than 100% of the value of the initial annuity, then it can help your asset test as well. And I'll quickly just explain that strategy. So an annuity is a source of income for a defined period. So it provides a regular income, and it's not subject to market movements. And it can complement the age pension and other assets like an account-based pension. You can actually hold it within an account-based pension as well. It has some social security benefits, and there are two main types. So the first one is a term annuity, where it's a fixed term. You might say it's a 15-year annuity, and you might hand over to the life insurance company $100,000, and they might commit to you to pay you $6,000 or whatever the figure is for that 15-year period. At the end of that 15-year period, you might have agreed to have a $20,000 residual capital value, and so at the end of that 15 years, they would pay you back that $20,000, and you will have received the annual payment for the 15 years. So that's a term annuity, it's fixed term. The other type is a lifetime annuity, where you give them a chunk of money, and they'll pay you an annual figure for the rest of your life. So there's the two types. In terms of what benefit it has for age pension purposes, is that due to the deductible amount associated with them, so the way that Centrelink calculates the value of the asset, it reduces the value of the asset over time. So if you purchased a $100,000 annuity, then, and in this case, the deductible amount was $6,532. And so I think 6 months in to the life of the annuity, half of that value would be reduced from the value of the $100,000. So a year in, it would go down by $6,500. So you can see that you're still receiving the same annual amount, but the asset tested for Centrelink purpose has gone down. So it reduces by $6,500 year on year, to the point that when after the 16th year or the 15th year, It's not assessed at all for Centrelink purposes. If you're still receiving the annual amount, you've got no asset tested, and you've got an annual figure coming through still. So it has benefits in that respect from a Centrelink perspective. So let's look at an example of Joe and Tina, and I've mucked up my names again, so it should be Joe and Tina, not Sarah. They're both 67 years of age. They have $250,000 each in account-based pensions and drawing the minimum payment. Their investor risk profile is defensive 50% and growth 50%, so a balanced investor. They've got personal assets of $20,000 and $50,000 in cash. They're entitled to a combined age pension of $20,277 as of the September 2017 rates under the assets test. So they're asset tested, and they've got an income requirement of $60,000. So they could continue as they are, and they can continue to draw down, receive the $20,000 pension from the government, and top up the other $40,000 income requirement from their $500,000 in their super, or in their account-based pensions. Or they could take out, for example, a lifetime annuity, and we're suggesting, or we're showing the example of $75,000 each in a Challenger lifetime annuity, which will give them a total of $8,392 per annum in income. So they've handed over $150,000 to Challenger, and Challenger have given them, or committed to give them, for their lifetime, $8,392. They've still got their account-based pensions with a reduced value, so $175,000 each, and they're going to need to draw just under $30,000 to make up the total income requirement. So it's around $22,000 from the age pension, $8,000 from Challenger, and $29,000 from their account-based pensions. There's the $20,000 from the age pension. Now, what this looks like in a big picture is that the bottom figure, the blue figure, is the age pension. You can see as the deductible amount kicks in each year relating to the annuities, each year the age pension increases because their assets are effectively going down. So this green amount is the account-based pension income, and so they're in the first year relying a lot on account-based pension income. That's their own superannuation money income. In the second year, it reduces significantly because the age pension kicks in more because of the asset test. It goes, and so to the point that a few years in, they've actually reduced significantly what they're drawing from their account-based pensions, and they're relying a lot more on the age pension, so the government age pension. And this is how it works. It actually increases your age pension and means you draw less on your own resources, meaning that they last longer. If we look at the example in the next chart where we haven't taken the account-based, so we haven't taken the annuity, the age pension doesn't increase at the same rate because there's not the annual deductible amount relating to the annuities that reduce the assets from Centrelink's purposes. So what happens is that the superannuation money is eaten into a lot more quickly, and therefore there's this gap here compared to the annuity, where there's a greater benefit in this scenario by holding an annuity. There's twofold reasons for that benefit. One is that there's the better testing, asset testing for Centrelink purposes, but the second one is the assumed level of earnings on the account-based pension as well, and that's the big unknown. If we knew exactly what our account was going to return each year for the next 20 years, it'd be really easy to make the decision, let's take out an annuity. The problem is we don't know what this our superannuation money is going to return, and therefore it's a harder decision to make. We are in record low interest rate environment, so there are some things to consider. when taking out an annuity. And I've reviewed it a number of times for clients and talked through the pros and cons of options, and it comes down to the fact that you're reducing the flexibility, so you can't take out lump sums like you can when you have an account-based pension. So you lose a little bit of flexibility. You're locking in a fixed rate of return, and we are in a low interest rate environment, and it becomes more difficult over time. If you're locking in a rate of return for the next 20 years, for example, where interest rates are at record lows, and then interest rates go up, the relative value of that money has gone down. So you actually could be locking into something at record low rates when it's not actually going to be that good when you think about interest rates going up in the future. And this is the big unknown. You don't know whether an annuity is going to provide a better return, or the market, or just investing in the market, is going to provide a better return. And as I mentioned, interest rates can reduce the withdrawal value as well. So it's not a clear-cut thing with annuities. It's weighing up the pros and cons. Generally, you would only do a small portion of your whole balance because it does lock away the money. But it is something that some people like to have, that security of a certain amount of their funds not being subject to market volatility and receiving an ongoing return on an ongoing basis. Just one other thing I mentioned I was going to cover off, and I'm probably stretching out too much content in the one webinar, but the Centrelink Age Pension changes. Now, there have been three major changes over the last 3 years. The first one was deeming of account-based pensions. The second one was where you had a defined benefit pensions, only 10% of the tax-free portion would be non-assessable for a Centrelink perspective. And then the big one that affected over 300,000 people Australia-wide was the asset test taper rate. So there's been changes to the age pension over that period. The one that I just wanted to quickly touch on was a deeming of account-based pensions, because if you started an account-based pension, that's moved your super to the pension phase. It is not a deemed asset, so Centrelink doesn't assume a certain level of return on it, regardless of what it does return. It's under an old system. So one thing I would mention that be good to just communicate a bit is that don't just willy-nilly change your account-based pension without thinking about whether it's the best thing. And so a change could involve rolling over your pension account. So it might be rolling it back to the accumulation phase. It might be rebooting it. So you might have a pension account and an accumulation account. You might want to combine those into the one account. Think about or review your situation before doing so, because it could negatively impact you moving from a non-deemed account-based pension to a deemed pension. It's a little bit of a complex thing to try and explain, but just if you did start the pension before 1st of Jan 2015 and you have been on the age pension or in receipt of the Commonwealth Seniors Healthcare Card for the duration since then, don't go and change or roll over that account-based pension in a hurry. So it applies both to age pensioners and those people that were eligible and remain eligible for the Commonwealth Seniors Healthcare Card since the 1st of Jan 2015. And just one last thing is, if you are drawing more than the minimum pension, it might be worth rebooting your account-based pension. In the case that you are drawing, let's say you're 65 years of age, you have to draw 5% of the balance, but because you need more than that, you're drawing, say, 10 or 15% or 20% of the balance, for example, then sometimes it's better to reboot the account-based pension, and it will have better Centrelink outcomes, particularly if you are income tested. So there is a case for the opposite. It's a bit of a complex thing, but just before you do make any changes to your account-based pension, if you did start it before 1st of Jan 2015, then just do review it first. I have some further resources. Retirement planning webinar series is available at our website, cornerstonewealth.com.au/retire 2017. The Centrelink Income and Assets webinar, that's this webinar, and the other Centrelink webinar is available at same address but /Centrelink 2017. And there's also Christian Super's help desk 1300 360 907 or their website christiansuper.com.au. And then there's Human Services website has got a number of links, including a calculator and financial information services officers who can help you, and you can give them a call if you're prepared to be on hold for a little while as well. I'm just going to run through these 8 questions that of the questions that you asked when you registered that weren't that I thought worthwhile covering off. All the rest of them seemed like they were largely covered off in the webinar that I was in the webinar content that I'd prepared. So Christine asks, can we use my super to pay off the mortgage and still get the pension when I retire? My husband is only on a basic wage. Well, Christine, if you're taking superannuation money and paying it off the mortgage, it means that you're reducing your overall assets, because a mortgage associated with your home being a non-assessed asset, it doesn't come into play at all. So paying it off with assets that might be an asset for Centrelink purposes, as in super assets, reduces your asset test and therefore increases your pension. So yes, you can do that. Can pay off the mortgage with your super when it's available to you. Norm says, do I have enough super to retire on? If that's your questions, then go to cornerstonewealth.com.au/retire 2017. There's at least 3 webinars that go through that question in a bit of detail and help you understand the concepts there. Marianne says, how do we help our children? How could they help us? And yes, we do trust them. That's great, Marianne. I think the best thing there is to understand gifting rules. If you are eligible for the age pension, or you will be eligible for the age pension in the next 5 years, then thinking about gifting assets to your children is worthwhile. The other thing you can do is, depending on how you want to structure things and your living arrangements, there are granny flat provisions with Centrelink where you can transfer your home into their name, and you can have a life interest. They're quite complex strategies, and there's lots of trips and traps with them, but there are lots of things that you can do there. But the biggest way you can probably help them is, apart from passing on your spiritual inheritance in faith in Christ, is to gift assets sooner if they have the financial understanding to handle those assets and utilise them well. Sally asks, is the transition to retirement pension after age 60 and under age 60 considered income when assessing family tax benefits? Now, good question. I'm not 100% confident in this one, but you could just check with Centrelink. But my understanding would be that it would be. So you would want to really understand, if you are eligible for the family tax benefit, that those moving to pension phase didn't negatively impact your family tax benefit. I suggest it potentially would impact it. It would be assessed. But yeah, well worthwhile either checking with Centrelink or search the Human Services website, or the tax office website actually. And Natalie asks, we have a small amount of super and own our home. If we downsize and make a profit, should we do it before pension age? A small amount of super. Yeah, good question. The more important thing, Natalie, is about what you do with the surplus, not when you do it. So if you want to stay in your home longer and receive the age pension, there's no real adverse effect of staying there longer. You might have fewer assets and therefore get a larger age pension by staying in that higher value house for longer. There also is a rule coming in that I think has been proposed and before the Parliament but not yet legislated, which is the downsize legislation, which means that if you have owned your home for 10 years and sell it after the 1st of July 2018, even if you were over the age at which you can normally contribute funds to super, you can put up to $300,000 each into your superannuation account. So the timing of when you move to or downsize and net some funds from it is really up to you personally, but there can be some benefits by deferring that for longer rather than doing it sooner, depending on your circumstances. Pretty hard to tell without knowing more about your details. Jan asks, what is the limit transferring super to the younger spouse? Will it be taxed if I withdraw money from my super before I retire? Well, if you have access to your superannuation money, then and you're over age 60, then and you make a withdrawal from your super, being over 60 years of age, there's no tax payable on it as long as it's a tax fund, like most funds are. Some rare funds, government funds or defined benefit funds, aren't what they call taxed schemes, but most funds out there that we're talking about these days are what we call taxed super accounts, and making withdrawals from those accounts when you're over 60 years of age is tax-free. The thing you need to consider is that if you haven't satisfied a condition of release, which is either you're under 60 and retired and don't intend to return to the workforce, or the other one is you're over age 60 and ceased a form of employment, that satisfies a condition of release and therefore access to your super money. If you haven't satisfied one of those two things, or you haven't turned 65, that's another condition of release. Turning age 65 is the catch-all. Then you might not be able to access the money to withdraw it. So you just need to weigh that up. But if you're over age 60, there's no tax payable on it. The limit of transferring funds to the younger spouse is currently under the non-concessional contribution limits. It's $100,000 a year, or if they're under 65 years of age, you can bring forward 2 years of contribution limit to make it $300,000 in a single year. Maria asks, what is the maximum amount you can earn on the age pension before the benefits cut out? That is on an earlier slide. For a couple, it is, I think, was it $77,000, something or other? I'll go back to the slide in a minute. But yeah, that's for a couple, and a single threshold is a different figure that I can't recall at the moment. I'll go back to where it's explained in the slides to answer that question, Maria. I'll just cover off Ken's question quickly. Whether to purchase an investment home that will be my residence once I retire, or invest the funds in another way. Yeah, really good question. Generally, if you're looking at moving locations into another area that you're not currently living in, I tend towards liking buying into that area sooner rather than later, so you're a little bit hedged against market movements there. But depending on your circumstances, you might be best off investing the other funds in more tax-effective strategies, whether it's in enabling you to salary sacrifice or move to pension phase and get some tax benefits. It's really hard to tell, Ken, without knowing more of your circumstances. But yeah, two broad options are, yeah, you do go down the investment track earlier to hedge against market movements in the area that you're looking at buying a new home, or you just focus on tax-effective strategies and change over, sell your current residence and buy the other residence at the same time. One of the benefits of taking that approach is that you can only have one primary place of residence that is exempt from capital gains tax at one time. And if you do a changeover, as in you sell one home and buy the next home, you've always kept your home that you live in as that capital gains tax-free asset. I'll just flick back a few slides to answer Maria's question about how much you can earn on the age pension before the benefit cuts out. You can earn up to just under $78,000 per annum and still receive a part pension. That's just under $3,000 per fortnight as a couple. It seems, Michael says, it seems the less we have, the less we have to worry about it. Yeah, that's right. I remember reading this book when I was digesting a lot of information about the biblical financial principles, and I think it might have been Ron Blue, who's an author and financial planner in the States, that's really written a lot about biblical financial principles, and he talked about the paradox of prosperity, and basically saying that the more we have, the more that we have to spend time on those things, and we end up being drawn away from the things that are most important in life. And so you've hit the nail on the head there, Michael. The paradox of prosperity is what you call it. Thanks very much for joining us. It was a pleasure to be on here tonight, and thanks very much for your interaction. Good night and God bless.